Well, hello and welcome to another video by Financial Learning. On today's video, I'd like to break down CleanSpark's latest earnings report. This is their annual 10K. So without further ado, let's get right into it. So the first thing I'd like to share is actually on the heels of that 10K, and that is their mining report. I'm actually going to go back to the September ending mining report because this should actually correlate exactly with the 10K. So just briefly, let's look at these highlighted numbers. So back at the end of September, they had a total Bitcoin mined for fiscal year 24 at 7,098, and they had a total Bitcoin holdings at 8,049. They had a deployed fleet of 188,520, and they had their exahash rate back then. Again, this is at September 30th at 27.6 exahash. All right, and jumping into the 10K itself, I want to go ahead and take a look at some of these other highlighted numbers. These should correlate with that mining result. And as you can see here, this is as of September 30th, 2024, they had a total mining fleet of 188,500. They had approximately 27.6 exahash per second, and they had a fleet-wide efficiency at 21.94 joules per terahash. Again, and they also talked about their mining numbers coming in at 7,092. All right, this next slide is actually just a snapshot of their different mining locations. Just wanted to bring it to everyone's attention. They do have mining facilities or mining sites in the states of Georgia, Mississippi, New York, and Tennessee. Some of those are co-locations. That would be Tennessee as of the end of the fiscal year there in September 30th, and also in the state of New York. And as some of you may know, based on their press release, at the end of December, they're actually going to end that co-location service with New York. That is their only hosting service because they did acquire the grid infrastructure. So as of January 1st, 2025, they're going to be 100% owners of their entire fleet. So that's important because that allows them to control not only the operations there, but also they're able to negotiate on their power rates. So they have full control over the operational excellence of their entire fleet. And looking at those different states, if you want to, you can go ahead and pause here. I'm just going to run through the numbers. You can see in the state of Georgia, they have 12 sites with 483 megawatts with an exahash rate at 20.6. That is by far their largest section there. Next is the state of Mississippi with 4 sites of 44 megawatts with just 2 exahash per second. New York, this is that co-location there with 1 exahash. 1.5 exahash, just at one mining location and 50 megawatts. And then last is the Tennessee location, currently has 79 megawatts, giving a total of 3.5 exahash and a total of 8 mining locations. Again, that is where part of that grid infrastructure. All right, and this is actually a very interesting slide. This actually states the total number of miners they own versus the amount that are deployed. That means they actually have some capability to increase their exahash rate, improve their efficiencies with some of these latest miners. So let's jump right into this. So it says they own approximately 235,000 miners as of September 30th, which of those 189,000 were in service. And the remainder is new machines ready to install. So again, they talk a lot about that megawatt infrastructure that they have. They have plenty of room to keep growing. They do like to use that green construction or that green infrastructure. That's basically that organic growth where instead of buying a facility that already has the different servers and the different infrastructure set up, they go ahead and purchase land in rural areas where they can get a very good rate on that megawatts or those kilowatts that they would pay monthly for those Bitcoin to be mined, and they're able to negotiate best rates, and then they're going to acquire the sites. They're going to build out their locations. Zach did say on a call recently that they're able to get those locations built and actually running within 6 months. This is a lot different than some of the other miners who are going more towards this this AI and this data center approach, a lot of those facilities take 3 to 4 years just to ramp up. And that is at the point of time where you can start to generate an ROI. And by that point in time, as Zach did mention, a lot of these facilities are already going to be making significant improvements. So it's going to be very difficult to have strong margins at that point in time as this specific industry, this data center industry, continues to grow. Moving along a little bit further down here, another couple things I wanted to point out is the miners' range. So they range in age of 1 to 45 months. So it's basically how long they have on their depreciation cycle before they get retired, and then those new miners are put in place. Their average age is about 12 months. So again, depending on the type of miner it is and the efficiency they're getting. And Zach also talked about the fact that it depends on the infrastructure where those miners are located. If they happen to be in an area that is still giving a very generous power rate, then even if the efficiency is a little bit lower, the cost to mine that Bitcoin may still make sense for some of those earlier age models. And then as we continue through the rest of this, I wanted to point out that it's also mentioned here that they will utilize their Bitcoin as collateral for lending agreements. Zach, again, mentioned a little bit about this on that fireside chat. As their Bitcoin holdings, their HODL gets closer to that 10,000 range. And as you may see, Bitcoin has just passed the $100,000 mark per Bitcoin. So we're definitely still seeing a price appreciation for Bitcoin itself. But as they get closer to that 10,000 Bitcoin HODL, they're going to be at about $1 billion is going to be the value for their Bitcoin based on today's pricing. So with that, there is a lot of leverage that CleanSpark can do in order to be able to get some yield off of that Bitcoin. And he talked a little bit about different strategies. They're going to go with the crawl, walk, run phase. So they're not going to jump in too far as their entire business is structured around efficiency and operational excellence. They're going to make sure that they succeed at how they're able to leverage their Bitcoin HODL. And a couple other things, again, as was mentioned on that mining report, you can see here near the bottom of this slide, it says that on September 30th, they held approximately 6,819 with a receivable for a 1,229 Bitcoin. So basically they were leveraging some of their Bitcoin to help them make some purchases. So they still have that as well as a receivable. They do expect to have that back in their possession. All right, and on this slide, I think this is actually a very interesting slide. I want to take just a brief moment to kind of talk a little bit about this. They actually share the global mining hash rate. So all of the miners, private, publicly traded miners, all of them combined. There's this is of course an approximation as these numbers are changing, day by day. But there's a total of 627 exahash per second. That is the total amount of hash rate for all the miners combined globally. If you look at CleanSpark as a company, again, this is as of September 30th, they were sitting at 27.6. So that means their market share is sitting at 4.4%. You can see how their market share has grown year over year. And it's important to remember that the halving did take place this fiscal year. So you may see some lower Bitcoin mining numbers as they continue to increase their efficiency. It's very, very smart the way they're doing it. They are scaling up. They are investing into their optimized miners, their more efficient miners, so that they're still able to have an aggressive and profitable profit margin on their Bitcoin mined. All right, speaking of revenue and profit margins, let's take a look at this slide here. Again, this is as of September 30th. You're going to see at that point in time, the average revenue per Bitcoin was $53,708. As of today, it's already breached that $100,000 mark. So within just less than a quarter, less than 3 month time period, we've already seen almost a double in Bitcoin price. And you can see there, CleanSpark is able to efficiently mine their Bitcoin at a total cost of Bitcoin mine at $39,936. That is their average. So if you take all their sites together where they're mining their Bitcoin, that is the average cost to generate one Bitcoin. So if you look down at the direct cost to mine each Bitcoin as the percent of Bitcoin mined revenue, this is going to give you the percent or the cost to mine that Bitcoin. So as of September 30th, it was costing CleanSpark about 74.4%. So they were making about 25% profit margin per Bitcoin mined. Of course, at today's rates, they're making a nice, healthy 65% profit margin. So it is looking much, much better for miners as the price of Bitcoin continues to increase. And as Zach also talked about on that fireside chat, they are still able to negotiate power rates. So the plan and the forecast does look like they will be able to continue to negotiate and get better and better rates in these rural areas as they work with these different power generation companies. All right, and as I mentioned, they did still, at the time of this earnings report, have some of these co-locations, and they still have the New York one until the end of this calendar year. But they talk a little bit about what type of profit margins they're seeing at these co-locations. And you can actually see that at these co-locations, the ones that they actually have hosting at. So they basically use their miners and they have to plug them into this other company in New York's infrastructure, and they are subject to those specific power rates. You can see that the cost to mine the Bitcoin at that location as of September 30th was 115%. So they were actually mining at about a 15% loss as of the end of September. Of course, with today's price of Bitcoin, it's actually still profitable at that co-location. They will be shutting that, they will be ending that co-location agreement in New York at the end of the calendar year. But as you remember from that table, that is a very small amount of exahash per second that they will be taking away from their overall portfolio, but they will be plugging in additional miners. As you recall, they still had a healthy about 46,000 miners available to plug into their already existing megawatt infrastructure they have at all those other site locations. So I don't think that's going to be an issue, and it does look like CleanSpark has already been kind of planning on how they're going to close that gap by the end of the calendar year. All right, and continuing on, we're going to look over the Bitcoin mining revenue. You can see their revenue increased by 125%, looking at fiscal year 23 compared to fiscal year 24. And they talk a little bit about, obviously, what contributed to that revenue will be those miners. So if you look at the end of fiscal year 24, they had approximately 188,500 miners compared to a previous year of only 88,000. So a very hefty increase in miners. A little over 100,000 miners were added to the overall mining fleet. So again, that is a very expensive cost. So you can see they had to raise a significant amount of capital in order to do that. And back then, the price of Bitcoin was nowhere where it is today. So a lot of what they did then was use equity financing. So they used some at-the-market offerings. We'll talk a little bit about that in a future slide, but just wanted to kind of talk a little bit about their Bitcoin mining revenue numbers. They did see a nice healthy increase, and that is, of course, due to the amount of miners they've scaled up. It's also worth pointing out that there was a Bitcoin halving that took place sometime in April of this fiscal year, and that did actually impact the overall number of Bitcoin being mined. And you can see that the price of Bitcoin is just now starting to see that increase. It's typically about a 6-month, 7-month difference between the halving and when the price does start to appreciate, just based off of that supply and demand of that Bitcoin. So the next section I want to talk about is going to be the cost of revenues. So again, this does not include the depreciation and amortization expenses. I have this section here boxed in red. By all means, please make sure you read through the whole section. I'll just touch on just a couple items here. So cost of revenues, again, was $165 million for the year end, which was an increase of $71.9 million, about 77%. So of course, as the revenue is increasing, the cost of revenue is going to increase. But I think it's important to look at the difference in those percentages. So their percent of revenue increased by 125%. The cost of that revenue only increased by 77%. So that is attributed to both the efficiency of their miners as well as the cost of Bitcoin compared to that previous fiscal year. Another section, just jumping down to the end of this last paragraph here, they said that they also incurred some hosting fees of 27 million, as well as some profit sharing fees at 4.7 million. So again, that talks about those co-locations. That was both at the grid infrastructure location in Tennessee, as well as that New York mining location. So again, I am looking forward to the calendar year 25 starting up, where they will be 100% owned, that there will be no more hosting fees or any type of profit sharing fees that have to take place. And jumping into the next slide, this is payroll expenses. I think it's important to look at this number. Obviously, as they're increasing their mining fleet, they're going to need technicians, they're going to need different operators to be able to run those pieces of equipment. Again, so it does make sense that you would see an increase in their employee count, especially as they're adding additional sites. Not all of this work can be done remote. You need people actually at these facilities to ensure that all of these miners are operating as they should. All right, now jumping back into payroll again, they had a total payroll of 74 million in fiscal year 24 compared to 45 million in fiscal year 23. So that increase again was about 106%. And as was mentioned, the increase was primarily contributed to a significant growth in locations, increase in employee headcount, along with employee bonuses during the year. So as I mentioned, as they take on additional locations and add more miners to their fleet, they're going to need more people to operate that equipment. And looking into the next section, this is their general and administrative expenses. You can see here they did have an increase as well. They had a total of 30 million in fiscal year 24 compared to 20 million in fiscal year 23, representing an increase of about 9.3 million. And again, the G&A for them includes, but it's not limited to, taxes, licenses, insurance premiums, travel expenses, and rental expenses. So again, this is not general administration in terms of any types of headcount. Payroll is a separate bucket here for the company. And the last section I want to talk about at the very bottom is this realized gain on sale of Bitcoin. What did they realize for sale in the fiscal year 24? They had a total sale of 1.3 million in the fiscal year 24. All right, and the next section, I think this is very important. We spent a little bit of time on here, and this is that impairment expense. They had for the total fiscal year 24, they had a total impairment expense at 189 million, and just the quarter four was 7.8 million. The remainder of that was actually in Q3. So if you did go back to that previous quarter, you look at their total cost of operations, you can see it was significantly negative compared to quarter two. And a lot of that had to do with this impairment amount. So in Q4, it looks like they've kind of finished up what they needed to in terms of impairment, just adding an additional 7.8 million. We'll talk a little bit about that number on one of the tables as we continue on, but just want to kind of point that out here in this paragraph. Next is going to be the depreciation and amortization. You can see they had an increase to 154 million from a depreciation amortization standpoint compared to the same period in 23, which was only 120 million. So that delta is at 33.8 million. So an increase in depreciation amortization. And again, that makes sense. They actually explain here is due to the increase in their miners and their mining related equipment. So of course you're adding 100,000 miners to the fleet. They were retiring some of their older miners as well. So you would expect to see some depreciation in each one of these fiscal years moving forward. Looking at other income and expenses, I think this is a really important thing. I love to talk about this, and this has to do with how they are taking advantage of some of that interest income. So if they have a significant amount of cash, some capital on hand, instead of just putting it in a bank, they're actually finding ways to make some interest back on it. For the fiscal year 24, they made a total interest income of 6.6 million, and they do have a debt interest expense for fiscal year 24, and that had a total of 2.4 million. So looking at the income expense for their cash on hand versus their debt, you can see that they actually had a positive net in terms of their cash versus debt expenses here. So that is a very important aspect. I think that their finance team did a great job of making sure that they had value to that cash on hand, and not just, like I said, putting it in a bank and having it sit. Next section I want to talk about is going to be that net loss for continuing operations. So looking at fiscal year 24, you can see that they had a total of 145 million on net loss. Again, I want to point out that they had that large impairment of around 188 or close to 190 million for the fiscal year. So if you were to take that away, they would be sitting at closer to about 48 to 50 million in the positive. So instead of having a net loss, they would have had actually a net profit. So again, that impairment is, in my opinion, what is detracting from their overall fiscal year in terms of their net loss versus potential profit. Jumping back in here, let's look at fiscal year 23. So they had 133 million net loss. So they did have an increase in net loss. Again, in fiscal year 23, they had no impairment fees at all. So again, I think they've done an excellent job of continuing to push and increase their margins. And we will see an even stronger fiscal year 25, quarter one, ending here at the end of December, just based off the cost of Bitcoin. And as they keep continuing to increase their exahash rate, that profit margin is looking healthy, and they are starting to mine more Bitcoin each month. All right, next section is going to be the liquidity and capital resources. So this is their assets versus liabilities. They had a total in assets of 1.96 billion. Compared to their total liability coming in at 201 million. So almost 2 billion in assets versus about 200 million in liabilities. To me, that is a very healthy ratio of assets to liabilities. So they've done a great job of continuing to grow their assets without incurring a significant amount of liabilities. And again, they did a lot of that based off of some of those equity financing agreements, those at the market, in terms of their shares. And we're going to talk a little bit more about that as we continue on. And right here, I have a box here. This is their financing activities from continuing operations. So how do they continue creating that nice large asset amount, as well as that Bitcoin HODL? And that had to do with a lot of these financing activities. You can see here, their total amount came out to 1.249 billion. Compared to fiscal year 23 at just 357 million. So quite a bit of financing activities going in, and you can see their cash flow from financing. They did mention that it's primarily due to proceeds from their at-the-market offerings. So they had a total generating cash of 1.231 billion, which contributes to about 106 million shares at a weighted average price at 11.43 per share. So again, I think that's important to show here. They are using shareholder equity to provide capital for the company, but they are converting a significant amount of that capital into assets. So they're purchasing additional miners, continuing to stay very competitive in this mining sector. So I do feel that the equity to shareholders will continue to gain value as this price of Bitcoin continues to increase, and as they continue knocking on the door of potentially becoming the #1 Bitcoin miner, if they can get that exahash rate up to 50 before Mara does. And for those of you that like to look at tables, here is their asset and liability table. Go ahead and pause the video here, and I'm going to continue on. All right, this next section here, this is going to be the stockholders' equity. So we talked about how they used that for financing, but how much of that is still remaining from an equity standpoint. You can see that there's a total stockholder equity as of the end of fiscal year 24 at 1.9 billion. So of course, that is going to be their total assets, compared to just 1 year ago at just 761 million. So they've done a great job. They've doubled their total assets, utilizing these different financing agreements as they continue to build their business and infrastructure, as well as those assets in miners. And I think it's also worth showing here, you can see at the end of fiscal year 24, they had a total amount of issued shares at 270,800,000 compared to a previous year at 160,184,921. So the delta there would be the amount of additional shares that were added due to either financing or other activities, whether it be employee compensation plans. But as you can see, based on the financing numbers, a little bit over 100 million of those shares came into effect for that. And this next table is going to be their revenue as well as their cost of operation. So again, if you'd like to look over some of these lines, line at a time, please feel free. And on this table, I wanted to stop really quick and talk a little bit about the impairment expense. So this is their fixed asset. So we talked about how they incurred that impairment in fiscal year 24. This is that total. It came out to 197 million impairment. Compared to previous year, there was no impairments. So then jumping down to the bottom of this table, you can see their total comprehensive loss attributed to common shareholders. So their loss for fiscal year 24 came in at 149 million compared to fiscal year 23 at 138 million. So they did incur a larger loss this fiscal year. However, again, I think it's important to show that impairment number. If that impairment number is removed, they're actually in the positive for the year. So again, if they are able to do a better job on their depreciation now that they have a better understanding of how these miners are retiring, I think that impairment expense should not play into a factor. And I think they stand to have a very nice profitable quarter, potentially, and the rest of the fiscal year 25 could look profitable for them as well, as the Bitcoin cost continues to rise and their HODL continues to grow. They're going to have some great opportunities to continue generating some additional passive income, if you will, with that Bitcoin HODL. So it's going to be interesting to see what kind of financing activities they do with that HODL, as well as what type of exahash rate they end up getting into early on in fiscal year 25. And if you'd like to understand what the per share count loss looks like, you can see here on this table, fiscal year 24 is coming out at 69 cents per share compared to fiscal year 23 at $1.30 per share. So again, the reason why the loss per share went down is because the share count did increase by a little over 100 million in fiscal year 24. So keep that in mind as you're comparing fiscal year to fiscal year. And if you like to look at their preferred stock, common stock, and some of this other total shareholder equity lines, you can compare fiscal year 23 to fiscal year 24 and really get a little bit further breakdown on the impact of those shares and exactly where they all came from. And one of the last big tables I want to talk about is going to be their cash flows. Again, I'm not going to go through all the details, but if you'd like to see a little bit more and kind of hone in and get more granular on the cash flows, by all means, go ahead and pause here and you can take a look at each one of these line items. So this is going to be their cash flows from investing activities. What all did they actually spend? They spent a total of 920 million in investment activities. You can see it has to do with a lot about these different miners they purchased. That was a pretty heavy amount, or at 740 million. And you can see some of these different asset acquisitions. Again, some of these are just the land. Others may have been some infrastructure already existing here. Those numbers are actually quite small compared to their miners. So you can see that between the fixed asset and the miners, that is a significant amount of spend in this fiscal year 24. And this slide here, this is their cash flows from financing activities. So what all did they actually get in terms of proceeds? So you can see some proceeds from loans, as well as some proceeds from their equity offering. So we talked about that at the market offering there, and that's a $1.231 billion. So looking at the net cash provided by financing activities as a whole, came in at about 1.25 billion. And then how much cash and cash equivalents did they end the fiscal year with? That was about 124 million. So they did spend a significant amount of their cash on those miners, as well as some strategic acquisitions and asset purchases. And for those of you that love to look at the different loans that they currently have, Here is one additional slide. This has a lot to do with the common stock issuance year over year. You can see from fiscal year 22 to 23 to 24 how that stock issuance increased. And the different methods at which it did. Some of it has to do with this ATM offering. Some of it is different settlements of restricted stock. And then some of it has to do with their stock options and warrants. So again, go ahead and take a look at this breakdown here. All right, and then one last thing, some of their commitments. So these may be just deposits, but some additional purchase order agreements that they still have cash to be going out of. You can see they have some purchase of modular immersion data centers. So this is the latest and greatest technology. This is much more efficient than the air-cooled miners is this immersion style. And as they build out more of this green land, which is just this barren land that they build their own infrastructure, their own data centers, their servers, and put in their miners, this is where they're able to actually put in these immersion data centers. So you can see they have a total of, they entered a contract for 165 million here for these immersion centers. And I think this is going to play a big factor in fiscal year 25 when you look at that increase in exahash rate. Also, you can see some of the purchase of Bitcoin miners. They have this breakdown as well. Talks a little bit about this Bitmain purchase order, what they've already purchased, what there still is left over to purchase. And then they talk a little bit about each of their fiscal years, how they have it lined out, what the kind of contractual obligations. So they have a total obligation for cash of 268 million for fiscal year 25. So again, depending on how much Bitcoin they end up selling, as well as what type of at-the-market offerings happen in this first quarter of fiscal year 25, this will let us know how much fundraising it's going to take to be able to make whole on this financial commitment here. All right, and finally, the last slide I want to cover with you all. This has to do with the subsequent events. So events that took place after the end of their fiscal year 24, they do share some of that with their investors here. So you can see starting with that at-the-market equity issuance. So there was some additional shares that were diluted into the common share count. Don't hate me for using the word dilution. That's what it is, folks. But they do it for a purpose. They do it to increase on their assets, they increase on the number of miners to keep them competitive. And a lot of that will be yielding some significant benefit as the price of Bitcoin continues to rise, as we're seeing today. So getting into this, so from October 1st through December 3rd, you can see that an additional 16.6 million shares were issued. So take that and add that to that 270 plus million. You're coming in around 286 and maybe 290 or so, somewhere in that range on the share count. Again, they did increase their total allowed shares or the authorized shares, to go from 300 million to 600 million. So they still have an additional 300 million shares available for any additional issuance, whether it be at the market offering or other types of potential, maybe some kind of secured notes. They do have 300 million available for that. So again, if there's any additional assets, any acquisitions that may come up that do look rather enticing, that do follow CleanSpark's operational plan, they do have some additional shares that they can use as collateral, as leverage to create those either at the market offering issuance or some different senior convertible notes. So again, just want to kind of point that out there as well. So they do still have some significant leverage that they can pull. Moving on, their grid acquisition. We know this took place at the end of October. They put out a press release, put out some 8K filings as well. But now that colocation is fully owned. They are now a subsidiary of CleanSpark, fully owned by CleanSpark. So at the end of this calendar year, starting calendar year 25, they will be 100% fully owned and operated. That New York location, that contract is expiring at the end of December. Looking into their long-term incentive plan. Again, you can pause here and kind of read through all of this. This does go through some additional changes to those companies' compensation committee and board of directors. some of their different improvements on how they established some of these long-term incentive plans. So again, this is just different things for various executives, various directors to continue to kind of feed their ambition, kind of incentivize them. Looking a little bit further down, you can see their increase in authorized shares. I already talked about this going from 300 million to 600 million. There was a shareholder vote that took place and that was approved. And then the last thing is some sale of miners. So between October and November, the company did enter into a sale and purchase agreement with some third-party companies, and they were able to sell approximately 29 million of their miners. So again, looking at the 29 million, adding that with the 191 million that they got from the ATM offerings of the 16.6 million shares, they've already raised in terms of capital an additional 220 million. So if you recall, they needed about 268 million to cover those committed orders in fiscal year 25. They've got 220, so only about a 40 million dollar gap. But if you recall their free cash on hand, they've got over 120 million free cash. So they're already set in a very good place to be able to pay all those debts, or I should say pay all those committed orders. So again, with those orders being paid, with them receiving those additional miners, that exahash rate will start to climb as they already have in their forward guidance, getting to that 50 plus exahash rate. I am very much so looking forward to it. They already have a healthy infrastructure with plenty of megawatts to be able to plug some additional miners into. So all in all, I hope you enjoyed this little bit of a video covering the annual filing. I try to make sure that I cover a little bit of everything here. So if you feel like I missed anything, drop me a comment. Let me know your thoughts on that. If I misspoke on anything at all, please let me know. Again, this isn't financial advice. This is just me as a humble investor taking the time to break down CleanSpark's 10K. So with all that being said, hope you all really enjoyed this video. If you did, please consider giving a like, share it with some friends. Please subscribe to this channel if you haven't already. Again, drop a comment. Let me know your thoughts on this. What other types of content would you like to hear me cover? Is there anything interesting with CleanSpark that you feel that I have missed in this coverage or in other coverage for this company? Let me know. And with all that said, hope you all have a great rest of the day, and I'll see you on the next one.